You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that funky tune means it's time once again for TWIFO. This Week in Futures Options, a program here on the old Options Insider Radio Network where we break down, as the name implies, the week that was, and in some cases still is, from a futures options trading and analysis and trending and volatility and all sorts of fun stuff perspective. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-scintillating Options Insider Radio Network. If you're just joining us to TWIFO for the first time, first off, welcome. Secondly, you got a lot of catching up to do. We got a lot of great archives to help you do just that. The easiest place to find those, theoptionsinsider.com, or just hit us up on your platform of choice, iTunes, TuneIn, Stitcher. Search for This Week in Futures Options, or if you want to just save time, Options Insider. That'll get you there too. And you can find it on all your platforms of choice. And of course, if all that's too much for you, via our mobile app available for iOS, Android, and the Fire OS. And of course, we also welcome you guys who can join us live every Friday, 1:30. Move that time down a little bit. It used to be 3 o'clock, now 1:30. I think that's easier for your schedule, certainly easier for our schedules as well. Helps a nice little flow in from volatility views as well. So hopefully you can join us every Friday, 1:30 p.m. Central, see how the sausage is made live via Mixlr. MIXLR. You can always hit us up, ask us questions via social media and everything else, including also in that chat room if you're logged into Mixer. So hit us up if you've got questions on all things futures options. Speaking of all things futures options, the major domo of all things futures options, a creator of a little platform we like to use around here quite a bit called Quick Strike, is joining me here in studio today. A fun in-studio visit. Mr. Nick Howard, the creator of Quick Strike. Nick, welcome back to the studio, and you get the due diligence points today. You were snowed into New York this morning, but you still fought your way out and made it here to Chicago, to the Options Insider Studios, just for TWIFO, sir. You get a badge of effort and valor for that, sir.
It is. It's my second week in a row, and I
know,
actually
2 weeks in a row.
Was on a plane, a train, and an automobile today. So
you are John Candy.
John Candy.
That's what you're telling me, huh? The late, great John Candy. One of my favorite holiday movies. I love that movie. Yes, well, you get the due diligence. You settle in there, sir, because we're also joined, holding down the CME Group hot seat today, by a newcomer to the TWIFO program, even though he's an old hat on the old network, Mr. Dan Passarelli, the founder of Market Taker Mentoring. Mr. P, welcome to the TWIFO program, sir.
Well, hey guys, thanks for having me. Glad to be here and looking forward to the show.
Yeah, it should be fun, a little bit of a fun foray into all things futures options. By the way, if you guys want to follow along with us live on the show, the easiest way to do that, not just listening to us, but you can actually generate your own reports completely free of charge, cmegroup.com/TWIO. Or Nick, you said TWIFO works now as well?
No, it doesn't work yet.
The caps work. You fixed
I'm working on the TWIFO.
You're working on the TWIFO. So right now it's still TWIO this week in options, because at CME all options are futures options. So I can kind of see how they would leave that F off, leave off the last F for fun. There we go. And you can generate your own report. So all the stuff we're talking about here, the skew, the open interest, the hot strikes, all that fun stuff. You guys can follow along. Easy, free of charge, easy peasy over there, cmegroup.com/TWIO. I don't know, Mr. Nick, should we start? I mean, it's kind of been the hot area yet again these days. You want to start back in the realm of all things WTI Brent, or is something else catching your fancy? After all, you did come all the way in here from New York just to do the show, so I'll let you get to pick your poison, sir.
Yeah, all the way in, just not to get back home, but just to get back to the
nothing
show.
to do with that. It was all to come right here, right now, sir.
Directly to the
office.
office.
Let the listeners feel their import.
I barely stopped at home. No, just so TWIO is my fault because you don't need to specify futures with CME, but I think TWIFO we should do it. So I'm going to work on trying to get that done. So I'll definitely do what I can there. Let's go with the WTI Brent, because as much as there's something going on there, I think we can get through it fairly quickly and move on to crude, where I think there's some interesting stuff going on. But again, and we've been covering this now over the course of, how many weeks is it? It's got to be 6 or 8 weeks.
It's
now.
over a month. Yeah, definitely going back to the early days of the new Trump administration, sir, when he started talking, even before he was in, when he was talking a lot of international regulatory change, and all of a sudden WTI Brent started moving.
Yeah, so it's again, like we mentioned last week, every increase in open interest is a new record, and again, we're looking at the same thing here, 5% increase in open interest, and with that primarily taking place in the contracts where we've seen them in the past. So the difference over the last couple of weeks has been that we saw some of the activity roll into the 2017 calendar year. So again, this week, we saw the 1.5 calls. Now, again, that's with the expectation that WTI will be trading $1.50 over the Brent. So we saw some new open interest there of 1,300 contracts. So again, people have moved their optimism for the Brent the Brent being caught by the WTI forward by about 6 to 12 months here, because a lot of the activity originally started in 2018, and now then it was into June 2018, and now it's in the December contract. So that's again something to keep an eye on, and that was the 1.5 strike. And we also saw the parity strike, 0.00 strike, trade quite a bit this week as well. So there was like a 1,700 lot that went up there, and that took place with about 25% of that was new open interest, but the 1.5 strike, all of that was opening for that trade. And then we saw some other activity on the downside on the -3 puts, where about 750 are new contracts there. And then we go out to the December of 2018. We saw an increase in open interest of about 5,000, but new open interest in the $3 strike. So even further out, there's optimism that WTI is going to surpass Brent by twice what the expectation was in the December contract. So still something really interesting to watch. The other thing to keep an eye on too is just the curves themselves. They're flat. They're pretty flat. I mean, if you go look at the charts, you're going to see a little bit of slope or contango in that futures curve. But when you look at it long term, like past April, May, June, you're starting to see the price is pretty flat. So I think we're going to have to try to take a look and although we see where the spread is just from a numeric standpoint where the strike is, but we should try to start plotting those on top of each other so we can get a really good handle on where that crisscross is starting to take place, or where the market's really starting to look at it, not just from a option strike trading standpoint, but from the term structures themselves of the underlying contract. So again, a new record in the WTI Brent, 157,000, 158,000 open interest, and that's a 5% increase, and what we're going to see is that increase was the same pretty much as the WTI contract this week as well.
Yeah, let's get into the mothership WTI here, Mr. Nick, because it was an interesting week. On the surface, you might think it might drive a little bit of volatility because there was a little bit of hither and yon, but at the end of the day, we ended up the week pretty much unched. It was kind of an interesting week, Nick. We started off kind of a bit of a pronounced sell-off going into right in the middle of the week. Then we saw this kind of pronounced rally. So we ended up pretty much netting out unched on the week, up plus or minus a half a handle in any direction, really. You can see this for yourself, listeners, if you fire up the market dashboard over there and then look at the TWIFO report. And you can see for yourself exactly what I'm talking about. But net, the future is pretty much unched off a little bit here by the end of the week, but not a lot of net movement, which is interesting. A little bit of back and forth, Nick. You'd think that would generate some vol, yet vol getting, I think the technical term is, crushed a little bit again out here, off about anywhere from a 2 points to beyond or so, depending where you're looking on the term structure. Crude vol, we had a listener write in, I think it was last week, Nick, kind of asking us about what's up with crude vol. What will it take to spark to some life? I think the answer right now is clearly not a down and up move in the same week, because it just crushed it yet again. I don't know. Crude vol can't catch a break out here. Can't get any love. I don't know. Maybe no premium buyers. I don't know what it is that no one and their mother wants to hold any crude volatility right now, because this stuff continues to get crushed out here. We saw some interesting moves in the Skew as well, getting a nice little bid out there. I'll let you break that down in a minute, Nick, when you do your quick Skew breakdown. We should also talk a little rent too, because we haven't talked rent in a while, and rent's always, I know, a fun little metric you guys out there. Is WTI paying the rent, Nick? I'll let you mull that one over in a little bit. Let's get to the hot strikes. What was lighting it up out here in WTI this week? You guys are always asking us, is it the 50s or the doubles? Those are the hot strikes again this week. And number one, it's actually a pretty close. It's almost a tie. The tug of war here, Nick, was pretty close. The 50 puts edging it out ever so slightly. 35,000, almost 36,000 contracts, including a good chunk of closing here on Wednesday. It looks like most of the closing was on Wednesday, so some of the closing there. Followed on the heels, though, right behind by the double calls, the 55 calls, with about 34,000 going up there. The good chunk of those, almost 10,000 going up, so roughly a third going up on Monday, and about another 9,000 on Tuesday. So a lot of that closing, especially on Monday as well, maybe going into that initial sell-off earlier in the week, Nick. People giving up the ghost on those doubles and then deciding later in the week, maybe get back in. So a little bit of action there. And then 54s, number 3, so a little bit less optimistic. 54 strike with about 28,000 or so. The lion's share of those coming on Tuesday and Wednesday, about 8,800 going up on both days. And then right behind it, Nick, it kind of seemed like every strike was kind of neck and neck this week. A pretty hot week overall. We should also light it up in terms of how much open interest. Open interest up nearly 5% again this week. It seems like every week we talk WTI, there's yet another new open interest level, which is kind of interesting in and of itself. And also, yet again, the lion's share of that activity, nearly half, about 47%, concentrated right there in that front month. Front month, back and forth action kind of all over the place here in crude, even though it netted out to no real big move in the futures and a massive crushing in the at-the-money vol. As we're talking vol, Nick, break it down for us here. What's going on out there in that Skew? Because you see that number popping up, but what does that mean? Puts up, calls down. Quick Skew will tell us, and then break down the rent for us if you would be so inclined. You're like the landlord here of the TWIFO show, so who's paying the rent this week?
Yeah, well, we'll get to the rent in a second, but you're right. If you originally logged on in the beginning of the week, you saw, or I think it was on Tuesday, it looked like volatility was up. But if you started to investigate that and looked at the attribution or whether vol was up only because so much data had come out and the price hadn't moved, that's what you would have found. So earlier in the week, we saw straddle trading about the same price, but volatility looked like it was up. But the reality is it was just the vol trying to catch up with the loss in premium from the days over the weekend. So that's going to be something that we're going to try to incorporate into this first line of the report, so we can get a little bit of theta attribution, so you guys get a pretty good idea of that first month. You got to really start to pay attention to that first month inside of 10 days. Because when you see volatility up, it's really just more than likely making up for the time that's moving forward. As far as the rest of the curve goes, yeah, I mean, we started out around 54 at the beginning of the week, which is, obviously where we left off last week, and we had a little bit of a break. Saw a little bit of volatility, but we kind of moved back up into the same place, and we're more or less right back where we were, 10 cents here and there from the beginning of the week. So again, like we've been saying over the last period of time, I mean, we're already in a pretty low volatility world for the crude oil, and we just got lower this week, and by probably around 2% across the board when you start to look outside of the front contract. So we are getting pushed down further, and like we've been saying, and like anybody who pays attention, you're going to see when you trade consistently within a range for a long period of time, and like we talked about last week, until there's something significant on the upside or the downside, we're going to see volatility continue to get beat up a little bit. It's got a couple black eyes in the black gold right now, so we're hoping for something. Now we heard this week also that OPEC was going to continue to enforce those restrictions on production. But then on the flip side of that, we see the shale producers are pushing, and I think they were projected to be like 520 million barrels over or whatever, some 520, and then I forget the magnitude, but it was big over the course of the year. They were going to be overproducing, so in the U.S. So, you get the OPEC wanting to have a reduction, and then you get the U.S. overproducing, which doesn't bode well. It's a tug of war, basically, is what you got there. So one of two things: we're going to stay within that range, or the overproduction is going to be so much where the other countries say, well, we're going to do the same thing to sustain the dollars that we need to keep going over here. So this would be the first time, and again, I'm just sort of looking at the numbers and listening to the news. Long-term expectation, I would think you might see some more pressing to the downside. But with that said, when you start looking at the volatility of the 25 delta risk reversal, we have all positive swings this week. So that means the calls and the puts got a little tighter. So what we're seeing, if we go out to the April contract, if we say April, May, June, basically, we could call it 1% closer. So the calls got a little more expensive to the puts by 1%. We were negative to the puts by about 4 volatility points, and now we're about or 3.8. Now we're about 2.8. So what's that mean? It means, right, that the difference is smaller, but what we see when we look at the quick skew chart is that the calls actually are moving more toward the at the money, and the puts were kind of where they were. So we're starting to see a little bit of sentiment where we're less beat up on the upside, and the puts coming in a little bit. So there's a bunch of things you could start to look at there. If you think that's not going to be long lived, you can start looking at doing at the money call spreads where you buy that and selling the 25 delta out call, or if the puts start to look like they're a little bit cheap, you can and you feel like you have some opportunities there in the skew in the collars, you can start looking at that trade as well. So volatility beat up, the skew kind of getting a little bit more positive, meaning calls are getting a little bit more bid to the puts. And then as far as the rent goes, Mark,
is it paying the rent, Mr. Landlord?
Well, if you look, we have the rent, and that's basically the number of ticks that the underlying needs to move in order to pay for the volatility. And at least from a today's standpoint, you could see if you look at the little belly in the curve for the week, you see that at 54 traded down to 51 and change, and then traded back up to 54. So inherently, that's going to tell you that it probably was doing. If you were able to pick up some of your deltas on that downside, you were going to pay some of the rent. But today, as far as it was, you got like a 1.5% move. We have the rent in there in the pricing sheet, and then we have two columns: change over rent and range over rent. So the net change was almost covering the rent, but the overall range definitely covered the rent. So it did pay for it today, but you had to probably work it pretty good to get anything out of it in the front month. Because you could see what happened to the price after the fact.
All the people are writing in kind of hand-wringing, Nick, about why is the vol so low? Why is the vol so low in WTI? But the nice flip side of that is that the rent is cheap. So when the vol is low, the rent is cheap. So that's a nice thing. Doesn't take a huge swing, doesn't take a huge dramatic movement to pay for that rent. You're kind of living in a WTI slum right now. Take advantage of that. You're living in a nice area at slum rents. How's that for a nice anecdote there, sir?
Right. Well, it's like you go to the store, you buy something, you think it's a good bargain, then next week it's a better bargain. But like we've been talking about, if you trade, if you own options and you could trade that range, that's great. We also talk about selling strangles around those high open interest strikes, right? So right now the 50 strike is the big open interest, and then you have sort of ascending ties between the 55, 57, and 60 strike in those first few contracts. So you can pay the rent, or you can sell your property in terms of strangles. But I think, like we always, vol could always go lower, and it will until something happens. But we're getting down in the 20s, and if you go look at the historicals over this over the 30-day contract, they're getting really, really toward the bottom end of the range over a long period of time.
All right, before we move on from all things crude, let's bring on our person holding down the CME Group hot seat, Mr. Dan P., the black hat one over there at Market Taker Mentoring. Now, Dan, you've been in the education game, the options education game, for quite some time now. I won't say how long, so I don't age you, sir, but quite some time. So you've seen a lot of trends come and go. You've seen a lot of ebb and flow, literally and figuratively, out there in the marketplace. We brought you on because you kind of wanted to get some of your perspective. You deal with a lot of traditional equity and index options traders coming to you, learning for education and mentoring and all that stuff. But obviously, this is a futures options show. So what kind of interest are you seeing from that audience now in these products? Obviously, crude, gold, wheat, others have kind of been making a lot of headlines. FX after Brexit. So there's been a lot of commodity-dominated headlines of late. So how is that impacting your clientele? What are you seeing in terms of interest from them in commodities and trading things like WTI options and gold options? So break it down a little bit for us. What are you seeing out there anecdotally from all your legions of clients?
Yeah, it's been kind of an interesting spectator sport. Just kind of watching what the education, market is, if you will, or at least the education interest. For a long time, it was really great to be an equity option trader, and it still is for the more sophisticated traders, but it's changed a little bit because what's moving has changed a little bit. Right now, the stock market for investors is pretty great. Every day on average, it goes up like another, 0.2% or something in the S&P 500. So it's great sitting there watching your long-term investments slowly grind out and hit all-time highs. But as an option trader, you start to get a little bit limited in the things you can do. But the things that really are interesting, in politics and just worldwide economics are what? We're talking about energy here. We're talking about oil, interest, foreign currency. And so people's interests have kind of shifted over to that sort of stuff. People are really, really interested in futures and futures options. So, yeah, we've been seeing a whole ton of interest of people kind of sniffing around saying, hey, I'm kind of a little bit more interested here in what's going on with interest rates. I know interest rates are going up. Is there a way that I can take advantage of that? I'm watching currencies and, what the dollar's doing against the Chinese currency. Is there a way that I can trade that? So we actually went as far as having started a futures class here at Market Taker because we've had so many people just kind of asking about it and being curious and wanting to learn.
I guess that's a good sign, right? You're starting a new class. That means there's demand for it. Well, Dan, kind of traditionally, we've seen a lot of people start looking at these products, on the other side of the fence, looking for the greener grass, usually when volatility is kind of low. And right now, here we are, beginning of the year, and volatility, the VIX cash shy of the 11 handle today. So volatility a little bit hard to find in your traditional broad equities and indices. So has that been a driver for you as well? Are you seeing people coming to you? Because obviously a lot of options traders, they're hunting for yield, they're hunting for a little vol, and they're not finding it. Traditionally, a lot of maybe not in WTI these days either, as we just laid out. But is that another big driver you're seeing? People are looking a little bit farther afield to try to find some yield, try to find some vol, and they're hitting upon other products out there in the commodity space that could deliver maybe where the equities aren't right now?
Yeah, I mean, in the equity markets, the historical volatility is so low that it becomes really, really attractive on the surface for income traders, people doing credit spreads and IronCndrs and that kind of stuff. But the implied volatility for the equity market is just so darn low that those spreads kind of lose their attraction. Now, to be fair, and this is true whether you're looking at securities options or, trading equity options via the commodities market or the futures market rather, the implied volatility has been residing above the historical volatility for some time now. So even though it's low, it's arguably still overpriced, but still it doesn't really get a lot of people's juices flowing and saying, hey, this is a great time to be selling option premium. It's like not a very exciting or enticing time to be doing so. So, right. And it's just kind of like any other business. If you think of trading as any other business, hey, if people aren't buying apples, well, maybe they'll buy oranges. So let's get into the orange business. If it's not a great time to be trading options, and it's not a terrible time to be trading options on the equity market, don't get me wrong, but if the grass is a little greener, as you put it, Mark, sometimes with futures and futures options, well, hey, there's nothing wrong with adding that to your business, to your trading portfolio. And that's definitely what I'm seeing a lot of people doing.
Your profile, I think, was on our option block program yesterday. Someone rolling a pretty sized covered call position. I've forgotten what individual name equity it was. Rolling it out a substantial amount of time, like 3 or 4 months, for a whopping 12 cents. And, I see that kind of stuff. I'm starting to think maybe this it's time for the hunt for yield to start migrating over to the commodity side of it. Maybe not WTI, but there's other hot spots for some vol and some action. We're going to get into one of those right next here. I know a lot of you guys like to watch the shiny stuff out there. Another interesting week out there in shiny stuff land. The gold bugs will be happy again here, Nick. The futures up about 15 handles or so, about 1% pretty much across the board out there. So gold bugs back in the driver's seat, at least for the time being, after I know there were a lot of sad faces out there from all the gold fans over the last month or so when we saw that protracted sell-off. Maybe, just maybe, this is the turnaround they've been waiting for. We also saw vol creeping up a little bit again out there as well, Nick. I think partially reflected, I'll let you get to it more when you get to the quick skew, but obviously partially reflected by the fact that we keep creeping up that skew, and those calls obviously have a bid, and so you keep moving up that skew, and the calls have a nice pop to them. You're going to see vol creeping up a little bit as well. Interesting trading, a little bit more even trading out here in the gold than we saw in WTI this week. Only about a third of the paper going up in the front month, but still an active week. Open interest increasing by about 7%. So yet another hot week out here in good old shiny stuff, aka gold. If you're asking us, what was the hot strike, number one with the bullet out here this week? Is it the calls? Is it the puts? Well, surprise, surprise, it's the calls leading the dance yet again. I don't think that'll come as a surprise to too many of you out there when we see the futures up yet again. And of course, the gold bugs out in force about the 12-half call. So nice even round strike. The March 12-halves leading the dance, about 9,000 with about 3,000 of those, about a third coming on Wednesday. The lion's share of that this week looks like pretty much opening paper too. So people reestablishing or opening up new positions over there on the 12-half strike. Then we come down to the 1,200 puts. So it's that nice even risk reversal, the 1,200, 12-half risk reversal kind of. Actually, before we even get to that, I'd be remiss if I neglected the 1,200 puts were active, but not as active, Nick. It was more calls this week because it was actually the Aprils, 1 month out reflecting again that kind of a little bit more uniformity to the trading across the front few months out here in gold. It was the April 1300, so a little bit more optimistic here, Nick, with about 5,600 taking the number 2 spot here with about 2,400, actually more than that, coming, almost half of those coming on Monday, with a good chunk of those opening. So people establishing new opening April 1300 strike trades out here in gold this week, which is kind of interesting, followed by the 12 quarters out here in April, 12 quarter puts with about 4,700. So a lot of action coming out here. Then puts not to be done in the front month as well, with about the same number, the 12 quarter puts here, 4,700 or so in the front month as well, March. A lot of that opening as well, including a good chunk, about 2,000, almost all that opening on Tuesday. So an interesting time here, Nick, from a volatility, from an underlying, from a skew perspective. So why don't you break it down for us here? All things quick skew, as you are wont to do, sir. Remember, quick skew listeners, that's a cool tool that allows you to break down the movement of the skew independently. So what's happening in the put wing and what's happening in the call wing. So you don't have to see one number, you actually see where it's moving. And then also Mr. Nick, a.k.a. our resident landlord here on the TWIFO program. Are we paying our rent this week in gold? I have a feeling I know what the answer is, but I'll let you do that for us.
Yeah, I'm going to jump over to look at the rent after we take a look at this, the open interest stuff. But like you said, Mark, if you go down the report and start to look at the put-call ratios for the volume this week, we're going to see that the calls were definitely in fashion as opposed against the put. So all those ratios are well below 1. Most of them are below 0.5. So we're seeing 1.5 times the volume or almost 2 times the volume in the calls to the puts. So, you mentioned the 12.5 strike, the 1,300 strike. You keep going out on the curve. You go out to the May contract, you get big change in open interest in the 1,350. You get highest volume in the June strike in the 1,300s, and then you go out to the July, you got 1,350, and then August 1,300, and then we start to see even more optimism. From a strike standpoint, we get a 1,500 trade out into September, but the big one, I think, and we haven't done the crazy trade in a while. I don't necessarily know if it's crazy, but it is eye-catching. How about the eye-popping trade of the week in terms of the gold? We have all the way out in the June to 2018. We have 10,000 lot pretty much of the 1,550 calls, with half of that being an opening. So you start to see people paying attention out that far. Then you really. And that's when you want to kind of keep an eye on those months. And the thing is, if you're using the report, we defaulted to 6 contracts or the entire first year. So a minimum of 6 or the entire first year. So typically when I go out there and I look at the report, I tend to always, on the commodities, I tend to always go to the second years, mid-year, June, and the December. So especially for crude 2 and the WTI Brent, because if you're familiar with those markets, those are where the farther dated trade concentrates, the half year and the full year. So I always bring those. I don't have those on as defaults, but I always bring those up, and you could take a look at those. It's pretty straightforward. And as an FYI, too, in about a week on the open interest profile tool, which is available for free on the CME Group website, we'll be adding a new tab. There's the open interest profile tool, and then there's the expirations, but then there's also a summary tab next to the expirations. But however, you'll be able to look at an openings report, so it'll show you all the strikes that opened that week. Now, it won't be the strikes that had there's an open interest report which tells you the greatest change, but these will be all the new strikes. So anything that hasn't traded, has 0 open interest prior to that, and you can look across the entire product spectrum. So that's kind of good when you start to see, because the gold and the corn and the wheat and the beans and stuff like that, they roll new contracts in during the interim. So you have the stuff that's on a longer period of time, but then you get these new contracts feathered in. So it's a good place to go when those contracts start to roll in to see where that open interest is. As far as the rent, we could probably stay. How many days to expiration? We could look at March. It's got 2 weeks to expiration, but if I bring that up and take a look at the pricing sheet, I can see that the change on at least for today, the change on the day was pretty much below the rent, but we definitely paid the rent from a range standpoint. So we had enough of a range going on that the volatility paid for itself. At least without just looking purely at my ratios and not looking at the futures chart, that's going to be what I would imagine it is. So again, here's another example, right? So Mark mentioned earlier how you would expect, given where we're going, that we'd start to see a little bit of skew in the calls. But when you look at it just from a real percentage point or a richness or cheapness to the at the money, we're still pretty. It's a still pretty saucer. It's a regular kind of smile shape with a little bit of a belly. So you're seeing a pretty flat volatility from 25 delta put to 25 delta call. And I'll put that quick skew out here shortly, and I'll follow it up with a vol curve as well, so you can see what I'm talking about. So when you look at the quick skew, you're going to see the current numbers sort of moving towards each other, and not very rich to the at the money. So really what you got is a market that, again, same thing, I like to think of it this way, is they're not really sure. You get a little creep on the volatility on the upside, but we want to keep taking a look at the skew, the vol curve, and then the quick skew itself.
All right. Speaking of taking a look at things, we got a lot of your questions we want to hit on too. I believe it's already been going for a half an hour here. Crazy. But let's get to it with our futures options feedback segment.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Welcome to your feedback. This is the portion of the show where we get your questions, your comments. You take us in all sorts of weird and wild and wonderful directions. Let's kick things off. We actually took you in a direction before the show. We asked you here, a little pop quiz. We said, what's your go-to futures option strategy? And we said if yours didn't make a cut, then you could send in some alternatives. But we gave you a pretty straightforward list. We said long call or vertical, long put or vertical, and then covered call / short put, because they are the same thing at the end of the day. And then to funky it up a little bit at the end there, we gave you an IronCndr / fly or butterfly. So kind of squeezing 3 strats into one. Again, you don't have a lot of choices when you're limited to 4 slots over there on Twitter, but we do what we can. Dan, let's start with you. Talking futures options, obviously you talk to a lot of your clients and mentees over there on a regular basis about what strategies they like to use and stuff. So maybe if you have a choice, if you want to give us that, go ahead. And then what do you think is winning our poll?
Oh, yeah. Well, let me see. Where are the choices again here?
Long call / vertical, long put / vertical, then a covered call / short put, or an IronCndr / ironfly / butterfly. Those are the 4 collective choices.
Wow. Well, I'll tell you what. I have been seeing a lot of the students that I've been talking to are doing a whole bunch of verticals. So I guess I'd go with that one.
Long call / vertical or long put / vertical? What are you feeling, sir?
I'm going with long call / vertical. That's what I think is going to. That's one I think is going to win.
Interesting choice, sir. That's all I'm going to say. Mr. Nick, same question to you. Of course, I'm going to turn my screen here so you can't cheat because you are in the studio and you're known to cheat on these in the past. So what do you think? What is your choice if you have one? And then what do you think is winning our poll?
Well, if you listen long enough, you see there's 2 kinds of trades that I like, and mine are generally delta neutral vol trades. So I probably am not on this list, but I'm going to say the IronCndr fly butterfly is too many legs to do for regular maybe, and then I'm going to go with just to be different, probably the covered call short put. I'm going to say.
That's kind of the way I was leaning to. I would think that would kind of take the top of our poll. But I started thinking about it too, and I said, well, wait a minute. A lot of people are getting into commodities because they want a little more vol maybe than some other areas. So maybe they want some actually long premium strategies as well. I don't know. So I was kind of torn between that, and of course the last one is kind of like a hodgepodge of everything thrown in there. It's so many strategies. I kind of want to pick that one, but I was leaning covered call short put, but it looks like it is the hodgepodge that is winning. 42% choosing the IronCndr / fly. Yeah. butterfly. So that surprised you, the two there next. Yeah, well, I guess we give them enough choices in there.
Just a lot of legs.
You put anything IronCndr on things, people love it these days. I don't know. So so we led with that, a little bit of a hook. But yeah, and then number 2, Dan, you were close there. Number 2, long call / vertical, 33%. So you were right on board with that one. No love for the long put, 0%. No one's buying any puts out here. And apparently they're not trading WTI, Nick, because we know people are buying puts out there. But yeah, no love for the puts out here. And then 25% coming in for the choice I thought was going to do better, which was the covered call / short put. That's only up for a few more minutes here through the duration of the show. So if you're not listening live, listeners, unfortunately, you won't be able to make your voices heard. It'll be done by then. If you are listening live, get in there. Hit it up, make your voices heard, change things up. If you don't like those results, make them change. All right, we got some other questions here. This is a good one, actually, I think, for you, Mr. P. This one comes from 65 Chevy. I like that handle. He says, this is for TWIFO. Well, you sent it to the right show. Well done, sir. Great show. Thank you, Mr. Chevy. He goes on to write, quick question. Are covered calls as popular in futures options as they are in equity options? Do they have the same performance characteristics? So 2 actual questions in one. He's trying to go for a twofer here. I think we'll allow it. Well, I think from the poll we just saw, covered calls maybe aren't as popular. I know if this was an equity poll, they would have been all over, the premium writing strategies. So maybe not. And that's also interesting anecdotally. I think when a lot of the feedback we get on this show, we don't get as many people asking us. Obviously, there are people out there looking for yield, and that's still a common trade. But people trade futures options, I think, a little bit differently. I do see more premium buying. We talked about this before on some of our other programs, too, like LSFO and others, where the weeklies trade pretty actively in a lot of products. And people buy premium on the weeklies, which is not things you see as often on the equity options side. So there's a little bit of a different nature, a little bit of a different use case to the trade out here in the futures options. Dan, I'd be curious, though, your opinion on this. You're out there, kind of, where the rubber meets the road here from an education perspective, the front lines, if you will. Would you say that covered calls are as popular with your futures options and your futures traders out there as they are with the traditional equity guys? And then also, obviously, Skew is a many-flavored thing in the commodity landscape versus the equity option landscape. So maybe why don't you walk us through some of the nuances of performance of a covered call in different Skew environments, if you would be so kind, sir.
Yeah, covered calls are not as popular in the futures options trading world as they are in the securities options trading world, the equity option trading world. And it's not because, from my observation, it's not because buying options is more popular than selling options in futures options, but it's more because of just the utility of what a covered call does for you. Covered calls are so popular in the stock market because investors who already own stock as long-term holdings squeeze a little more out of it while lowering risk by adding a call to it. So that's a ready-made sort of overlay strategy because people are net long stocks. It's not like futures where, there's zero open interest until a contract is created. When there's an IPO in the equities market, then stocks exist and somebody owns them. Like in futures, there's one long for every short. In stocks, in equities, somebody owns that, if somebody's holding it, and so they can sell a call on top of that. But, while it may be true that there are some people who invest for the long term with futures, it's a very different sort of scenario. A lot of times I think that some of them are, people who actually use the underlying, who are using futures to hedge or to, take positions at a future date or something like that. So just by the nature of what a covered call is, it's a little less popular. If you want to be selling options in the futures options arena, you would be usually way better off, instead of taking a pretty substantial risk position, the buy rights. And I would think that people probably call covered calls buy rights more in the futures options world. You have pretty profound risk having a buy right, because if there's a big move against you, you can lose a ton. Whereas if you do a vertical spread, I think that maybe selling a credit spread is a much more popular way of selling options in futures options, rather than a buy rate where you're long a future and then you're short a call or something.
Yeah, you're right. You don't have that inherent, long bias that we see in the equity side all the time. People are doing all kinds of things in the futures market intraday, and there's a little bit different perspective. You're right. Whereas equity markets, index markets, everyone's kind of just biased long, hence the skew we see out there and the propendence for overwrites out there and everything along those lines. Good question there, Mr. 65 Chevy. Yeah, the skews are all over the place in commodities as well, which is kind of makes it interesting and maybe a little bit of a nail biter sometimes, or a bit of a snooze, depending on your product, really, for writing covered calls. All right, good question, Mr. Chevy. Let's move on to... here's a good one for you, Mr. Nick, because they're talking about your stuff here. This comes from George, the creatively named George. I like that handle, because just his name. He says, I like the OI heat map. So there you go, Nick, a little love for Quick Strike. He says, your stuff is slowly bringing me over to the dark side. I don't know if he means your stuff, Nick, or if he means this show. He wrote into the show, so I'm guessing he means the show. Yeah. But, I'll give you a little credit there, too. Maybe your heat maps are bringing him over to the dark side as well. But he's got an interesting question here, one we haven't really touched on before. A little bit of the dark side of options itself in terms of maybe the deep, deep waters. He says, I'm looking at brokers now, but I'm not clear on futures options margin. Is it the same span or portfolio margin like regular options or something different? And when are you going to hit on hogs again? Well, we can answer the last part first. Probably not today. I don't think we have time to hit on lean hogs today. But who knows, Nick? Maybe since we got a request for it, maybe we can see if we can rotate it into the rotation. This is the second time in 24 hours someone has asked me about hogs. I was at an event last night of all things, and someone started picking my brain about lean hog options. And I thought, wow, this has never happened in the decade now, twice in 24 hours. So maybe something is afoot with hogs, Nick. We'll have to go see. Maybe the game is afoot out there. So maybe we'll give you a tentative promise, George, for next week's show. We will investigate hogs, and if there's something hot out there, we will put it into our surprise product of the week. How about that, George? All right, and his other question here, Nick, he's looking at brokers. He needs a little bit of a breakdown on margin. He's hitting the span. That span is obviously kind of the starting point for kind of all margin conversations, and it's obviously a big part of the margin scene in the futures option space. You're about as much of a margin expert as I am, Mr. Nick, but if you have any thoughts on this, have at it, or if you want to point them somewhere, feel free as well, sir.
Yeah, I was going to say, if there's anything that is the hardest to get your head around is the futures options margin. I think the best thing to do would be, there is a whole initiative over at the CME Group to educate the retail trader about futures and options as well as the margin. So you can go out to activetrader.cmegroup.com, and you might be able to find some resource there. They do have a span tool, so you could put some legs in of your trades, and it'll tell you what the margin will be there and what the maintenance margin will be. So that's probably a good starting point. And if you're interested in contact for the retail group, you can tweet us or shoot Mark a note, and he'll forward your information over to me, and I'll be glad to steer you in the right direction. However, as far as lean hogs goes, you probably are asking a fairly prescient question at this point, because lean hog open interest this week is up 8.5%. So we went from 184,000 to 200,000. So there's quite a bit of activity there. So we'll make a promise to keep an eye on it this week, and we'll see what looks interesting out there and try to cover it next Friday.
Yeah, a new topic for the show next week, #HogLove. Everyone's out there asking about lean hogs. So something's clearly up, Nick. The people have spoken. We'll see if we can get you some hog love for the show next week. All right, moving on to another question. This one's right up your alley here, Mr. P as well. So this comes from Vegan. He, or perhaps she, writes, hey, during the election, we saw the post-election markets crash during the event and then shoot up the next days, of course, referring to all the tumult there in the after hours of as it became clear that Trump was going to win. We saw a massive sell-off in the markets, and of course, once the concession speeches came in, they were a little more conciliatory, and people expected. We saw the markets rally as a result. They go on here to write, when rare events happen, odds are the market will have a hard time going down again in the near future. How can you trade that with options in mind? So Dan, he or she is essentially asking, you got a near-term bullish market. It could be in the index, could be in a broad equity, could be in a commodity. What's your poison? What's your preferred path for trading something like that using options?
Yeah, I mean, I think that a lot of times when you see stuff happen where, the market was selling off when one candidate was doing well and rallying when the other candidate's doing well. And then, and it was Trump is when the market was falling every time he was doing better in the polls. And then seemingly ironically, once he was elected, then the markets rallied pretty hard and have rallied since. I think a big part of that is just that uncertainty is over. Just the uncertainty of any election, but particularly this past one. It was a doozy, wasn't it? I think that's probably one of the things that's keeping the market higher. But if it is your thesis that the market will just kind of continue doing what it's been doing and maybe grind a little higher slowly, and what implied volatility is living above historical volatility as it's been for the last couple of months, a few months actually, I mean, that's an easy answer, right? What gives you positive delta and negative vega? Well, selling put spreads, right? Selling put spreads worked for years while Yellen was keeping interest rates so low and the market was just kind of grinding higher and higher and higher. It worked back then, and it kind of works now too. Even though implied volatility nominally is very low, like I said before, I mean, it's still higher than it should be, arguably. The only thing that I would caution is that in situations like this, what goes up must come down at some point. And so many traders and investors get fooled by just thinking, oh, well, it just keeps going up. It's just going to keep going up forever. And that's definitely not the case. There's likely to be a small pullback, maybe even a series of small pullbacks, and possibly, because interest rates were so low for so long, there could be a pretty significant pullback later in the year. So my advice, trade it, but trade cautiously.
It's a good point about realized volatility out there, Dan. We just touched on that on our Volatility Views program not too long ago here on the network, and saying people are lamenting how, at the money volatility and things like the S&P shy of the 11 handle these days, but yet realized vol out there is probably about a 6 or a 5. So it may seem cheap on the surface, but when you see what's actually happening out there in the marketplace, perhaps not so cheap after all. There we go. There's that music, listeners. That means we've unfortunately come to the end of yet another epic journey through the world of futures options. Kick things off, as always, WTI Brent got into a little bit of hot WTI action afterwards. What will it take to boost some WTI vol, to get some vol out there? Well, it clearly didn't happen this week. People continuing to hammer down. I think it's going to be what we said on recent shows, Nick. It's going to take you can't have this back and forth action. You definitely need to pick a direction and go for it. And when we start seeing that, maybe we'll see vol start to pop. Definitely to the downside, maybe to the upside if it calls and get a little bit of life again out there. We shall see. Also saw the gold rally continuing, breaking down some of the hot action out there as well. Who knows? Maybe we'll get a little hog love for next week. I think Nick's already digging in. I can see him. He's already digging into the quick strike numbers for hogs for next week. So his interest has been piqued. And, of course, we got a bunch of your questions as well. We love to hear from you guys. But before we go, as always, let me check back in with my cohorts, my partners in crime, see what's cooking. Let's start with you, Mr. P, holding down the CME Group hot seat this week. What's cooking in the land of market taker mentoring? And if our listeners are interested in your futures or indeed futures options courses, where should they go? What should they do?
Yeah, that's really kind of our newest thing here at Market Taker is our futures course. And we're actually giving a free trial, not a free trial, an almost free trial, but pretty close to free trial. And you can go over to markettaker.com/futures49. So that's market, like stock market, taker, like you take something, 2 T's in a row, markettaker.com/futures49. And you can get a 1-month trial of our daily live futures class where you get futures ideas every single day. It's only $49 for a full month of everyday classes. You get about 5 trade ideas each class.
There you go. Check them out, markettakermentoring.com. If you want to learn more about traditional options or futures options or a little bit of futures or all of the above. He said free, so hold him to it, listeners. Hit him up, say I heard you on TWIFO and you told me free. So we'll see what you can do. Dan's going to get mad at me right now, I know. But before we go to that, Mr. Nick, what's cooking? You guys are always coming up with interesting new tools, fun things. We got George here. He loved the OI heat maps. Just luring him to the dark side. What else can we expect coming from the Quick Strike team this week, sir?
Well, I think I mentioned it last week, but it became, I guess, more official when you saw a banner out on the CME Group website that Quick Strike is now available as an integrated part of CME Direct, so you can actually dock a window and have your mouse clicks follow you in that window to the different Quick Strike information we've made available to the CME Direct users. So that's the first thing. So if you are not on that trading platform or you're looking for a trading platform, I can recommend CME Direct. I have it on my desk. I use it. It's well thought out, and the fact that we have the wonderful Quick Strike data integrated at no charge, I think it's a pretty good incentive to take a look. As I mentioned earlier, there'll be some new look to the open interest profile tool, meaning we're trying to get more consolidated information out there. So you'll see some interesting things like openings across the entire product, where you can look at OI in delta terms or in Vega terms, and you can look at the historicals of those as well. We're going to be doing some rolling front month open interest, that kind of stuff. So keep an eye on that. And then if you're familiar with some more advanced portions of Quick Strike, we have a tool called Quick Vol, which you do get as part of the Quick Strike subscription, as well as pieces in the CME Direct platform. But Quick Vol has been revamped and consolidated and made really easy. And if you get a chance, shoot us a note and we'll give you a trial of that, so you could take a look, so you can see some really long-term historicals, get some downloads, that type of stuff. So some good stuff coming down the pike.
All right, good stuff as always, Mr. Nick. We don't talk about CME Direct, get a lot of chance to talk about it here on the program. Some listeners may even be surprised to hear they can trade directly through the CME platform, hence the name CME Direct. They can connect their broker and go right. People are always asking us, what's a good platform? What's a good broker platform? There you go. You got one right there. You can access, get the Quick Strike tools. What more do you need there? So maybe we'll have to talk about that more on future shows. Unfortunately, that's all the time we have, listeners. On behalf of Dan and Nick, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing. Of course, for all of you who can join us live, we'd love to see you there every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern. And we'll see you next week for more TWIFO.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QuickStrike1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.